So welcome everybody to tonight's webinar. I'm glad you've all found the time to join us. Thank you very, very much. We really do appreciate it. We know it's people's valuable time. So it's great that you've made the time to be here. For those of you watching the recording, thank you as well for taking the time out of your day to watch the recording of this webinar. What we're going to be talking about today is a little known technique to allow you to benefit from the markets, regardless of whether you know whether the markets are going up or down, okay? And this is a strategy that a lot of professional traders use, but it's really not seen that much in the retail markets. And obviously, as we said in the email that we sent out, what we're doing here is we're giving you a bit of a sneak peek into what's involved in the mentoring program. So the type of stuff that you'll learn in the mentoring program, it is all very, very powerful. Even if you use this technique here in isolation, so if you use it on your own or on its own, you're still going to be very, very successful. It's going to improve your trading a hell of a lot. Okay, so don't think that just because we're giving you a sneak peek into the mentoring program that what we're about to show you here isn't going to help you. It's absolutely going to help you. It's one golden nugget of information, and there are many, many more within the program. So basically, we hope that you enjoy this. We hope that you find a lot of value. If you have any questions, then please feel free to ask them. What I'll do is I'll continue through the presentation and then I'll answer any questions at the end. So the regular disclaimer, the content of this webinar is not investment advice and should be used purely for educational purposes only. All participants are advised to seek their own counsel prior to investing or entering into any trade. Spread betting and any other type of financial trading carries a high level of risk to your capital, the possibility of losing considerably more than your initial investment. The content of this webinar may not be suitable for all investors, and an individual should ensure that they're fully aware of the risks involved. And if necessary, you should seek the advice of an independent financial advisor. So let's start off by talking about FX, because this is where most of you have come from, right? Most of you started off in the Forex world, and there are very, very good reasons for that, which we'll talk about in a little bit. But just some of them are things like, obviously, there's a low barrier to entry. It doesn't cost a lot to get involved in the Forex market. And there's a hell of a lot of marketing around FX, saying how it trends so much better than any other market and all of that kind of stuff. And that's ultimately the reason that you came to FX. And we're not saying that there's anything wrong with FX. We make a good deal of money, a good bit of profit from the Forex markets. But all we're saying is that there is more to trading and investment than just looking at the Forex market. So if you're able to kind of broaden your horizons just a little bit, okay, just even if it's for the next half an hour, broaden your horizons, open your minds, okay, and listen to what we have to say, because I promise you, we're going to show you a world that you probably didn't even know existed and opportunities that you weren't even aware of, all right? So in the Forex markets, we trade in pairs, right? But ultimately what we're doing is we're essentially trading one economy against another. Now, on the surface of it, that seems pretty simple, as you only have to have a view on two variables to make a trade. However, the problem is that those two variables are extremely complex. Okay, so on the surface, you're thinking, well, I just have to have a view on how one country is doing against another, and then I'll be able to take a good trading idea and I'll be able to make some money. The problem is that the variables that affect those countries and those economies are very, very complex. You've got to think about the monetary policy. What are the central banks doing? The fiscal policy. What are the governments doing? Various economic indicators, and how do they affect the markets based on what the markets are focusing on at one particular point in time. You've also got participants in the markets like the large hedge funds, but you've also got corporations. So these are two large players in the Forex markets, and both of them with different motives. So the large funds will have a profit motive. Corporations will also not necessarily have a profit motive. They'll just be picking the best time to repatriate some of their profits from overseas. So you've got a number of different participants in the markets and a number of different factors affecting the FX markets. On top of that, you've got natural disasters, obviously, which can have a big impact on your Forex trades and your Forex profits, that so many people find it so difficult to make money from the FX markets. on the surface, you think, yes, it's very, very straightforward. That's the best place to go and put your money. But when you dig a little bit deeper and you go beyond the charts and you go beyond the technical analysis, you can actually see that there's a lot involved there. There are a lot of variables to sort of keep track of in order to be able to be consistently profitable. So suddenly something that seems so simple can become complex and difficult. You're exposed to risks from so many different angles, and there's, as I said, there's little wonder that so many people fail because they just don't pay attention to these sorts of risks, and they don't pay attention to these factors that are going to affect their trades. You see, you need to be consistent to be successful trading. But the question is, how can you be consistent with so many different factors affecting your trades? So have you ever wondered, if there's more to trading than just betting on the outcome of individual trades, of that one trade? Then maybe there's a better way to approach the markets that will yield more reliable results. Okay, and the reason I say reliable, not consistent, is that you can be consistent, but you could be consistently bad. So that's not going to help you. You want results that are reliable, results that you can depend on, good, profitable results. If you're one of those people, then you were right. There is a better way, and that's absolutely what we're going to show you within this webinar right here. And that approach is something called pairs trading. It's a structured approach to running a balanced trading or investment account, okay, or portfolio. What this allows you to do is, one, protect yourself against flash crashes and black swan events. So if you go back to August of last year when the S&P in August of last year, the S&P sort of dropped 10% in a day. There were a lot of people that lost a lot of money that day, if they came out of their positions. On that particular day, our portfolio, it swung 1%. So really nothing to worry about there. So we protected ourselves, and that's what we're going to show you here. The approach that we're going to show you, okay, is an approach that 7 of the top 10, of the 10 top performing hedge funds utilize according to Bloomberg. But before we go into that, let's quickly go over some of the reasons that retail traders and retail investors fail. Why do you go wrong? Because if we can understand why you're going wrong, then we can look at what we can do to make it right and to make you a better, more consistent trader. You see, often retail traders, they're right on the direction, but they're wrong on their timing. And there was a study done into this by one of the brokers where they basically looked at the trades of a number of their clientele, if you like, and they saw that ultimately they were correct on the direction of the trade, but they were wrong on their timing. Okay, so there you have one of those issues that so many retail traders face. They strangle their trades. They're so dependent on the outcome of that one trade that they put the stop too close. They end up get into a position and they get stopped out of a position. They get into a position, they get stopped out of a position again, and they end up losing money. But at the end of the day, they look at the charts and they see that actually they would have made money. If they had have just stuck with that particular position and not tried to strangle it, not try and get in and out, they would have made money. So one of the big reasons that retail traders fail is that they don't know how to approach the markets, even when they have the correct direction. They don't know how to construct their trades in the right way that allows them to withstand the market going against them. They're kind of under the mistaken impression that, you have to be right on the direction and you have to know which way the markets are going right now in order to make money. Or they do things like they'll have a small trading account so they won't allow themselves a large enough stop, even though they know that they should have a big enough stop. They won't allow themselves to have that because they've got such a small trading account. And if they take a tiny position size, then the win means nothing to them. Okay. And as a result of this, as a result of the consistent losses, they start to make bad trading decisions and they compound their problems. And psychologically, they become very fragile and they're not even able to identify good trades anymore. Okay. So I don't know how many of you recognize some of these issues here, but I certainly do when I first started trading. I'm sure Nikki does as well. This is something that the majority of the traders face when they first start out. So what our job is to help you understand this and to help you find a solution to these problems. Because there's no point in us telling you where you're going wrong. if we don't give you a way of getting around that, and if we don't give you a way of putting it right. And that's exactly what we're going to do in this webinar here. So what if you had an approach that removed the requirement for you to be right on the direction of the market? Because even when you are right, you're losing money, right? So what if you didn't have to be right on the direction of the markets? What if you were no longer looking at the outcome of just one trade, okay, but you're looking at the overall performance of your trading account? So you had a portfolio of different trades that you were looking at. What if you were no longer stressed about your trading and you actually started to enjoy the process? You stopped looking at trades that would have made you money if you got in later or had a wider stop, and instead you just watched them contribute to the growth of your account. You see, successful investors utilize a popular approach to structuring their trades that enable them to profit from rising or falling markets, regardless of whether they know that the markets are going to rise or fall. There's a way that you can construct your trade so that you can actually make money regardless of which way the overall market goes. So successful traders, they don't live or die by the outcome of just one trade, because they understand that one trade is just a drop in the ocean. Okay, when they have a portfolio, a balanced portfolio of trades and investment ideas with different themes and strategies driving them, and hence they have a smoother equity curve and they have less of a psychological roller coaster. Who here would like to have that sort of a trading approach? Who here would like their trading to be as stress-free as possible? Obviously, I'm hoping a lot of you. Otherwise, this is a wrong webinar. So let me ask you a question. Can you tell me with any real certainty where the S&P 500 is heading in the next 6 months to a year? Who here can tell me? I'm guessing there is probably not going to be many of you. Now, before I go any further, there are absolutely ways to tell where the S&P 500 is heading in the next 6 months. There are ways to do that. Okay, but for the average retail trader, that's a little bit beyond their skill set. They don't know what they need to look for in order to be able to take this sort of a view. And if they can't take that sort of a view, then ultimately they'll end up losing money. So here's another question. Can you tell me which company you think is better out of Google and IBM? Okay. So on the one hand, you have Google, now one of the world's largest companies. Okay. Android, which is Google's mobile operating system, has more of the mobile phone market share than iOS. And Google benefits by taking a revenue share of each of these app sales. It's a leader in research and development for future technology, so they're protecting themselves against what's going on in 5-10 years time. They're always innovating. We live in a YouTube society, okay, and rising viewing numbers online is only good news for Google, right? And of course, it's still the #1 search engine with revenues from ad sales. All right, these are just some of the high level type headlines about these companies. IBM has been declining in sales over the past decade. They do a lot of business in Europe, and hence the euro-dollar exchange rate has really affected their profits with how much exposure they have to Europe. They've got a falling share in the server and storage markets, and analysts are slashing their forecasts. Okay, so as opposed to saying the S&P is going up or the S&P is going down in the next X amount of months, what if you were to just look at two companies and say, I think this company is better than that company? Even if you don't look, right? If you don't look at some of the fundamentals, okay, behind a particular company, what if you were to just look at the chart? Well, this is the IBM chart over the last couple of years, going down. So it went through a period of consolidation, and since then it's been going down, down, and down. What about Google in that same time period? One direction, right? Up. So here's an idea. What if What if we were to trade Google against IBM? What if we were to say that we think that Google is going to outperform IBM? That's it. We're not going to do anything else. We're simply going to say Google is going to perform better than IBM in the next week, 2 weeks, month, 3 months, whatever your time horizon is. Doesn't that sound like a much easier trade to you? And let's take a look at that chart. So the ratio charts for Google versus IBM. So like Forex pairs, we're creating a company pair. Look at how that chart over the past few years, so since 2012, has been going in one direction. Each high is breaking the previous high, more or less. Each low is not breaking the previous low. So you could have stayed with this if you're a longer term trader all the way through this here. And you could have gone from where the market was down at, the ratio was down at 140 up until it reached a high of around 615. That's 4 times your money. Okay? And that's not even considering the fact that your stop loss would have been a lot closer than that. So it's actually a hell of a lot more times your money. So pairs trading, you're not taking a position against the market. By taking a trade like that, we don't even care where the S&P is going. We don't care what the central bank is going to do. We don't really care what the government is going to do. Because we're not taking a position against the overall market. We're saying we're going to buy one stock, we're going to sell one stock. So here's what happens. If both stocks rise, and we're right in the sense that Google is a stronger company than IBM, we will make money. If Google rises and IBM falls because it's already in a downtrend, we make even more money. If Google and IBM rise at the same sort of pace, then we'll be at break even. The only time we lose money, if we were wrong and Google is actually a stronger company, if IBM is actually a stronger company than Google, that's where we lose money. But there's a number of different, quality gates that you go through before you even get to that trade to get it that wrong. But I'd said that we're not taking a position against the markets. So if the S&P falls 10% in a day, what do you think will happen? Both of our positions will go down. So IBM, the one that we're short, the one that we want to go down, the weaker position, the weaker company will go down. Google will also go down. We are hedged against the markets. Because what should happen is that the weaker company actually goes down more than the stronger company. So even in those circumstances where the stock market falls off a cliff, you can still stand to make money. You see, the great thing here is that your aim isn't even that one stock will go down and the other will go up. Your aim is simply that the one that you are bullish on goes up more than the one that you were bearish on. And by trading this way, you protect yourself against those big market shocks. So suddenly, the direction of the overall market is no longer important. So this is all a great idea, right? But how do you go about doing it? How do you actually put this into action? How do you find these trading ideas? Well, there's a number of different ways. Okay, and there's actually a really good book. It's called One Up on Wall Street. It's written by a gentleman by the name of Peter Lynch, who runs one of Fidelity's huge funds. It's called the Magellan Fund, and he's one of the most successful fund managers over about the past 3 decades. And he wrote a book called One Up on Wall Street, and it's all about how to go about identifying different stocks for your portfolio. And one of the things that he says is, look at what you're comfortable with. Look at what's close to home. Names that you know and love. So high street names, look at those. Next. Next is a company that's done tremendously well over the past few years. Really, really, really well. If you put your money with Next, you would have quadrupled your money over the past couple of years. What about looking at maybe a company that a friend works for? Okay, or if you don't want to do that, maybe you want to get technical. Look for a stock that's risen X%, and you can define what the X is over the past year. Or a stock trading at its 52-week highs, its yearly highs. Because if a stock's trading at its yearly highs, it's trading there for a reason, and it's probably going to continue going higher. Or look for stocks with record volumes, with a lot of volume behind them. Because if a stock has a lot of volume behind it, it has it for a reason. It means that there's action in that stock. If you can combine that with a stock breaking out to new highs, then you're in for a good thing. Once you have the idea, you need to analyze the stock, and you can analyze it technically or fundamentally. Now, so technically, is it trending? Is it breaking out? Fundamentally, has there been any positive news behind the stock? Is the company bringing out a new product? Okay, is it opening up a new store somewhere? Is the company consistently beating its earnings? If the stock meets your criteria, it becomes a candidate for a trade. And just before I go any further, before a lot of you sit there and think, well, this is all based on stocks, I don't trade stocks, therefore I'm going to switch off. Did you know that the majority of your spread betting companies allow you to trade stocks as well? So you can trade stocks the way that you can trade FX. You can just do it with a little bit more consistency behind it, with a little bit more protection than your FX trading. Okay? So don't look at this, don't watch this and think, well, my broker doesn't allow me to do this, so this doesn't apply to me. I think you'll find that if you look into it, your broker absolutely does do this. Once you have your idea, once you've got a valid candidate for your long position, you then need to identify an offsetting short position. You can do this by looking for stocks in the same sector, okay, but potentially has a worse outlook. So if you're looking at a technology stock to go long, look for a weak technology stock to go short. It's as simple as that. And remember that you're not looking for the offsetting position to go down necessarily. You just want it not to go up as much as the one that you were bullish. Does that make sense? If it does go down, then that's just a bonus. Okay, if it does go down, then you stand to make more money than if just one went up and one stayed in one place. Okay, that's when you really hit the home runs. Now, if all of this criteria stacks up, then you enter the trade. You place a stop loss on both trades at a logical level for you, okay? And you remember the key rule that if one gets stopped out, you must exit the other trade. You trade them together. You trade them as a pair. The trades belong together. One cannot survive without the other. So you get into them at the same time, you get out of them at the same time. Does that make sense? And I don't know if any of you, now that we've gone through this, if any of you have maybe read about this in the past and is starting to become a little bit familiar. For those of you that have read about it, the one thing I want to caution you against is some of the articles that say that pair trading doesn't work. It's a really, really, really dangerous way of trading. Because what those articles talk about, what they refer to is pair trading, but buying an undervalued stock and selling an overvalued stock, hoping for some sort of a reversion to the mean. That's not what we're doing here. You know that Nikki and I like trends. We like trading with no momentum. So we're looking to buy a stock that's trading high because it's trading there for a reason. So we'll buy it high, we'll sell it higher. We'll sell the one that's going down because it's already going down. We're not looking to stand in front of a train. We're looking to go with the momentum of the market. Pairs trading, you may have heard of it as different names. You may have heard of it as being pairs trading, ratio trading, long-short trading. But the type of long-short probably, if you want to remember this, describes it perfectly. Because long-short is exactly what you want. For every long position, you maintain an offsetting short position. The idea of buying and hoping that one stock goes up is a rookie approach, and it's a big reason that new traders fail. They become so dependent on that one trade and they make a host of mistakes as a result of it. Okay? Has that made sense to everybody? that approach to trading the markets? Does it sound like something that you're going to want to go away and at least have a look at? Because I promise you, your trading will benefit as a result of this. Now, you may think that this webinar here has been all about saying that, Forex doesn't work, okay, or something like that. It's absolutely not. The marketing, obviously, that you see is that Forex is better for a beginner than stocks. You can open an account with a broker for as little as $100 and start trading immediately. But the truth is, every market is difficult to trade when you don't know how. You can be just as successful trading Forex as you can stocks. And in fact, in a balanced portfolio, you should actually include both. So you should have stocks and you should have some FX in there. That's going to give you a smoother equity curve overall. The only thing that we ask of you all is that you open up your mind to the possibility of trading something other than FX and start acting and behaving like a professional trader. Michael's asking, which broker would you recommend for this approach? We use IG Index. IG Index pretty much give you access to everything in the world. So that would be a good place to start. So if you like what you saw in this webinar here, and you don't have to have liked what you've seen, but if you have liked it, then as you know, we are about to embark upon our professional mentoring program. It starts next week. Okay, actually, so we're closing the doors to the program next Thursday. That's when it will begin. That's when all of the mentees will get access to the first part of the program. This is a 10-week program of personal training where Nikki and I will work with you. Okay. We will teach you a repeatable process that we use to identify opportunities in the financial markets that generate profits time after time. This approach is included in that, but we teach you so much more. Okay, we'll show you our proven formula for entering trades at the right time, which ensures that you suffer very little drawdown. We show you how to build a portfolio of trades and investments that mitigate your overall risk while giving you the maximum upside potential. And one of the most important things that we will teach you during this time is how to identify the right markets to put your money into. Because one of the things that a lot of retail traders do and where they go wrong is that they say, well, I'm only going to pick euro dollar, or I trade these 5 pairs and that's all I trade. And if they're not going anywhere, well, damn it, I'm still going to find a trade in those pairs. And then you wonder why you're losing money. Professionals identify where it's best to put their money. Sometimes it's Forex, sometimes it's going to be stocks, sometimes it will be commodities. We want to make you well-rounded traders, okay? We want you to have an approach that's going to last you an absolute lifetime, okay? We're going to give you the key steps to achieving consistent, reliable results. It will be delivered basically structured over some structured video modules that will be released weekly on a weekly basis. Okay, and at the end of every week, we'll have a live Q&A webinar where we make sure that we answer any questions that you have if you haven't already asked them via the Facebook group, via the forum, via email. You can get together with us live once a week where we'll answer all of your questions, because the point of this is that Nikki and I are going to drag you through this process, whether you like it or not, to make sure that by the end of the program, you're in a position that you can attack the markets with confidence, knowing that you're going to come out ahead of the game as long as you put the process into place. This isn't a program where, you get all of the modules and then you're kind of like, good luck, all the best. We hope you do well. We're going to do everything in our power. It's personal mentoring. There are going to be face-to-face progress meetups as well each month, where we can get together and we can talk through your trading. If you're not able to attend live, that's fine. We'll give you the opportunity to attend a similar online meeting. You'll have access to the vibrant Facebook community where our previous mentees and now graduates of the program are sharing ideas, they're talking about their trades. And you'll also get lifetime support from Nikki and I. So if you ever want to drop us an email, feel free to do that. Okay. If you want to join that program, all you have to do is go to www.traderscorner.co.uk/mentor.html. Okay, that's www.traderscorner.co.uk/mentor.html. And you go to that page there and you'll see that you've got a couple of different options to allow you to sign up for this program. So we've tried to make it as accessible as possible. We were advised, well, before we started the program, we kind of were thinking that it should be somewhere around the £3,000 mark. We were told that actually it should be more than that, considering you get the personal access to Nikki and I, but we want to make it accessible to everybody. When we launched it last year, okay, to our initial mentees, we launched it for £1,000. And we said back then that it will never be that cheap again, and it won't be that cheap again for the personal mentoring that you get. This time round, we had to stick to our promise. We can't make it as cheap as last time round. But what we have done is we haven't put the price all the way up to where it's going to be when we relaunch the program in the summer. And I know that sounds like a sales pitch, but I promise you it's not. One person said to us during the program that it's almost like an obligation that we need to show people, you know, this approach to trading, you know, all of the stuff that we're going to show you on the program. And we had a lot of emails as well before from the last program saying that, you know, with Christmas coming up and everything, it just wasn't something that they could afford. And we took all of that into account, and that's why we're offering it for this price for this time round. But again, like we said last time, it won't ever be available at this price ever again. So if you're interested in the personal touch, if you're interested in the face-to-faces, and, you know, Nikki and I holding your hand, then this is the time to get in. All right, and I promise you, Nikki and I will do everything within our power, all right, to get you to the point where you can be successful trading. Are we also teaching the DAX course? So we show the DAX, we do teach the DAX system in there, but it's not in any way as in-depth as what's on the DAX Academy, and that's just to be fair to those people that have signed up to the DAX Trading Academy. So we'll show you the approach, okay? But it's not as in-depth, if that makes any sense. Andy, the Facebook group is an amazing group for this program. It really, really is. If you log on there, you'll see, well, you can't log on. If you do log on at some point, you'll be blown away. Let's just put it like that. Nigel, we don't have profit and loss figures to show because you can trade a number of different, there are like thousands upon thousands of stocks out there. So it wouldn't be possible to show you, you know, like you could for euro dollar or something like that, the way that the system performs. What I can tell you is generally speaking, we shoot for about 25% per year. That's unleveraged though, okay? So you can apply whatever leverage you want to that, but that's what we aim for on an annual basis. Kushal, all of the prices and everything is available from that page there. So if you hop along there, you'll see it all. David, long divided by short means that the stock that you want to go long, you divide that by the one that you want to be short, and that gives you the ratio. Okay, well, if there are no other questions, then I'd like to thank you all for joining this evening. Okay, really appreciate your time. As I said, I know that you're all busy people and you have other things to do. So thank you very much for joining this. I hope that you found value here. That was the point of it, is to give you a bit of a sneak peek into the mentor program, obviously. We did say that in the email, but even this approach used in isolation is also going to help you. So please don't discount it, you know, just because at the end of it we started talking about the mentor program. This is really going to help you. So make sure that you've made notes, watch the recording again, and if you have any questions, please feel free to drop us an email. Okay, so have a lovely evening, everybody. Take care now, and we'll speak to you all soon.